Welcome to Finance in Excel video number 8. We're in chapter 1, and this chapter will be unusual in that we don't have any Excel workbook to download and do financial calculations. We're just going to define some terms and talk about some concepts. Hey, this is last chapter 00. We talked about the basics of Excel and math. Now we're going to talk about finance. Now, this is a file, a PDF, and you can download this by clicking on the link directly below the video. If you're in the class, just go to our class website. Now, finance. This is an exciting time to study finance. Why? Because we've just had a financial meltdown, 2007. Still to this day, 2010, we see the repercussions. In essence, the financial markets, banking, financial engineers, creating things like credit default swaps, took capitalism and the banking industry for a ride. And the exciting, we got into a lot of trouble. The banks and everyone lost a lot. Governments unfortunately came in and rescued some of these banks, so some of the people involved may have received lots of cash when they probably shouldn't have. Nevertheless, what's exciting about this moment in history is that it's a fulcrum point. Moving forward, we do not know what the future of finance will be. It will be different than it was in the past. And although this class is mostly a real basic, mostly math-oriented class, some of the questions that people are asking right now in the field of finance, ever since August 2007, and when this first hit, and then in the later part of 2008, when Lehman Brothers went bankrupt, AIG and other companies in the United States got taken over basically by the government. Ever since then, people have been rethinking things. And some of the questions they're asking are, do free markets really allocate resources efficiently? Which means, do free markets really work? Are markets efficient? Later in this class, we'll actually get to talk about this a little bit. This one we don't talk about much in this class, but these are questions that people assume they had the answer for years in finance and economics, but now people are really questioning these. And do people act rationally? A lot of times in economics, they just assume that people make rational decisions. So the reason why finance is exciting, even in this basic class where we don't get to talk about these things, is because these questions are being asked, and the answer to them, coming who knows when in the future, will define the future of economics. All right, chapter 1, we're going to talk about these topics. Why corporation is an efficient business form. We'll talk about the structure of a corporation. We'll talk about the fundamental accounting equation, assets equal liability plus equity, define finance. Talk about the goal of financial management. We want to talk about why should we study finance in the first place. This is an intro class, and some people are absolutely never going to be finance managers, but they're taking this class. What are key questions to ask in finance? Talk just momentarily about financial markets, a lot more later in the book, and cash flow. All right. Now, another thing about this video, you probably want to hit the full screen button. In most of the other videos, you could have it small and you can see everything. But in this video, it's going to be kind of hard to see everything unless you make the screen big. Forms of business. There's all sorts of different forms, but the basic ones are sole proprietorship. Hey, just one person owns a company. Partnership, more than one person. And corporation. Here's some of the aspects of a sole proprietorship. It's easy to start. You just start one. Least regulated. It is hard to raise funds, though. Imagine if you go to the bank and say, hey, can I borrow some money? Whereas if you're a big corporation, you have an easier time getting funds. Big, huge drawback, unlimited liability. All this means in a nutshell is if you get sued, remember, sole proprietorship, not only can the person suing you take your business assets, means all the cash and things you have for your business, but they can also take your personal assets. Advantage, ding ding, sole proprietorship, single taxation. You just get taxed on your whatever your income is. Difficult to sell ownership. hard to sell a sole proprietorship. Whereas if you think of a corporation that has stock, and right, you can just go sell your stock if you have Microsoft stock. Partnerships, very similar to a sole proprietorship. General means you invest and work for the partnership. Limited means you just invest. Easy to start, somewhat regulated, somewhat hard to raise funds. Maybe a little bit easier than a partnership because you have more than one person. Same problem with a sole proprietorship. Unlimited liability. You get sued, they can take all of your partner assets and your personal assets. Advantage, single taxation. Difficult to sell ownership also. Now, unlimited liability. So, then comes along the corporation, and instead of having an individual and a business, you just create a separate legal person. Now there's lots of paperwork you have to file. It's somewhat hard to start, and it is can be heavily regulated. But once you have this corporation, the owners can invest their money, and if anyone sues the corporation can lose all of their corporate assets, I mean all the cash, buildings, everything like that, but they can't come after the owner. C Corp means a big corporation like Microsoft or Whole Foods Market International. S Corp is a small corporation. Limited liability company is actually an invention that's like a half corporation and half partner. The advantage to a limited liability company is you get the protection, which we'll talk about or I just talked about. It's called limited liability, which means if the corporation gets sued, you lose just the assets from the corporation, not the owner's assets also. So if you own stock in Microsoft and Microsoft gets sued and they go bankrupt, they can't come and take your house. So the advantage of the limited liability company is it's got that aspect of the corporation, but it says half partner, single taxation. So it's got limited liability. Limited liability company has the limited liability advantage of the corporation, but the advantage also of single taxation of a partnership. Big problem. Double taxation for the corporation. That means whenever your income is, you're going to get taxed on that, and then you're taxed again when you pay out a dividend. Now later we'll talk about dividends, but dividends are just when the company pays out cash to the stockholder. You have to pay taxes on that also. So double taxation. Easy to sell stock. Because once you buy, in fact, I could just go to the last slide and cover this one first. Here it is, page 13 in this downloaded PDF. Financial markets. There's primary markets and secondary markets. But get this, when Microsoft in the primary market issues stock, you may buy it, but Microsoft gets the cash. So original sale of the stock, right? When you sell the original one, the cash comes into the corporation. So the corporation is issuing the security. That's another word for stock, right? And then Microsoft gets the cash. Secondary market means you, the owner, now you have that stock. You can go to sell it to anyone you want, and that's called the secondary market. So after the original sale, owners can buy or sell the equity, the stock, or later we'll learn that there's debt also, debt instruments. You can sell them in the secondary market. You buy or sell the security. Here it is, the primary market, right? Here's Microsoft. So you give them some money, and they give you a stock. You are a new owner. But in the secondary market, you can just go sell this Microsoft stock to whoever else. Secondary market. Let's see. Whoops. All right, so easy to sell stock. Now, there is a reason that this class is mostly about corporate finance. By the way, we're studying corporate finance, but most of the math and cash flow tricks and financial statement analysis that we talk about can be used by anyone, not just a corporation, a nonprofit, or an individual, or a sole proprietor. But we're studying corporate finance. And we want to just briefly think about why the corporate form is better than sole proprietor or partnership. Well, we already talked about limited liability, right? If you get sued, they only take the corporation assets, not your house if you're a stock owner, right? But the main idea is if you have a good idea, right? You're an entrepreneur. You want to start a business. The corporation is great because you have access to funds. That means you can get money to create your business that's going to, create this good idea. Whether it's a new product like the iPod or a new service industry or whatever. Your good idea, if you have a good idea, the corporation is really excellent. And the reason it's most efficient because you can get funds quickly. Equity or debt, it says here. Equity just means stock, right? And we'll talk about the fundamental accounting equation in just a moment. Debt means you take out money. But if you have a good idea and you have a corporate form and you're well established, easy to get funds to do whatever you want. And that's, here's these reasons again, but at the top, easy to raise cash. Of course, the limited liability, ease of transferring ownership in the secondary market, and unlimited life, right? Sole proprietor dies, the business dies. If you die with some Microsoft stock, right? Microsoft doesn't die. Your stock goes to whoever you left it to. All right, structure of the corporation. Since this class is about corporate finance and corporations seem to be efficient in terms of getting funds, we have stockholders at the top. Right, so you own the stock. When you own the stock, you are the owner. Owners vote and bring in a board of directors. The board of directors then hires the managers, and the managers are inside the company running the company. Now, in general, see the arrows like that, so it goes owner decides everything. Owner votes these guys in, who then hire managers. If these guys, board of directors, hire managers you don't want, what do? We get rid of them. But in the real world, it doesn't always work that way. The managers oftentimes take control of everything, including picking their own board of directors. So sometimes it goes this way. Nevertheless, this is the structure. Doesn't always play out that way. Structure of the corporation. All right, finance class, right? Here's board of directors, and then here's inside the company. Where does finance happen? Here's CEO, executive officer, COO, operating officer, CFO, finance officer. There's also a CIO. In the information age, we have chief information officers. More and more, as history unfolds, being able to get good information and use it for business decision is very important. Here's the controller. Look at this, accounting down here. Here's the treasurer. Finance is almost always in the treasury department. Cash manager. Manage cash flow. Cash flow is going to be very important in this finance class. Credit manager. Do we extend credit to our customers? Capital expenditures. We'll have lots of fun in this class trying to figure out what projects a business might choose to engage in, or what businesses to buy, or what machines to buy using cash flow analysis and financial planning. Do we issue debt or stock, and other topics? So treasury, that's where we have all of our exciting finance topics. Now, fundamental accounting equation. Let's see if I can get this right. Oops, can you read? That's better there, no? No, there we go. All right, fundamental accounting equation. Assets equal liabilities plus equity. No problem if you've had accounting, you know this by heart. This has been around for 600 years. All of accounting and all of finance basically use it to this day. Now, what does it mean? If you don't know, just look at the picture, right? These pictures can explain it perfectly. If you have a house, 200K. If you pay 200K, then it's assets equals equity because you own everything. But most of the time, it's not like that. You go out and you get a loan. Liability just means DEBT, debt. You owe. So you go out and borrow 150K. That means the bank really owns your house. And then you put 50K down. That's all this equation means. And we'll be using this all the time in this finance class. When you buy an asset, a house, a truck, imagine UPS, a brown truck. They're buying that brown truck. They're buying buildings. Businesses are buying other businesses. Even inventory. They're all assets. So get this. If a business all of a sudden has a great new idea and needs some new machines, well, they need cash to go and buy that machine, right? Well, they can get cash two places. Boom, 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 boom. And so that's the liability and the equity. So if you have a new good idea or some asset you want to buy, you just go out. You can either do it with debt, equity, totally debt, totally equity, or some combination. That's what this equation means. Now, assets, things you own like cash, truck, building, patent. The accounting definition in GAAP is something like provide probable future economic benefit. Now, all that means is if you have the brown UPS truck, right? Future economic benefit, it means you're going to deliver the stuff and the customer is going to give you cash. The economic benefit is ultimately some income. Probable just is because you could crash the truck or the building could burn down. Provide. So assets always provide probable future economic benefit. Liabilities, just DEBT. That's all you need to know. Debt, that means you owe, we owe. Whoever it is, they owe. By the way, later we'll talk about there's the flip side. Anytime someone owes, the person on the other side, the flip coin is an asset, right? So if you borrow money, you are the borrower. The lender on the other side, of course, has an asset because you owe them the money. But we'll more on that later. All we're talking about is liabilities. That's when we borrow money. That means we owe. A contract to pay back loan and interest. Bank gets paid, or whoever it is, the lender, before you. I don't think I wrote this right. Bank gets paid before you went bankrupt. All it means is the bank gets your house. If you default, the bank gets paid first, always. That is a contractual obligation. The banker, the person who loaned the company the money, gets paid first when you go into bankruptcy. If anything's left over, you will get it, right? So if you default on this, the bank has to sell it. If the bank sells it for $100,000, right, that doesn't cover the debt, but that's all they get. The owner gets nothing. In business, it's true also. So asset, liability, equity. Equity is just, think about it. If you're thinking about liability as debt, just think about this as whatever's left over after you pay all the bankers. Whatever's left over. I always think of it this way. Assets minus debt equals equity, whatever's left over. Not only on the accounting records here, but in bankruptcy, that's also true. All right, the definition of finance from this. Actually, they don't give you a definition of finance in this textbook. In essence, they leave the goal of corporate financial management kind of as our definition of finance. But I'm going to give you one here. How to allocate scarce resources across assets over time in order to earn a return. That's the definition of finance. You can go Google it and look up 10 different definitions, and they're all some variation of this. Now, what this means is, first off, what should we invest in, right? If you're a business, an established business, should we go and get this machine, or should we go and buy this truck, or should we try to buy a different company, right? What should we invest in? That's the asset part of this, right? How to allocate scarce resources across assets. So what are we investing in? Second, should we use cash, equity? I mean, shouldn't say cash there, but just equity or debt. Cash is your cash can come from equity or debt. But that's an important question. Because you can go out and issue stock, or you can go out and issue some debt, right? This is the allocate scarce resources. Now, you can't go out and just get as much equity or as debt as you want. So the word scarce is there. But scarce resources, really that's the equity and debt you have, right? So how do you allocate? How do you take all the capital you have, either debt or equity, how do you take all of that and decide which assets to buy? Now, this definition then says across assets over time. And here's really one of the troubling aspects of finance. It's all about the future. The future is unknown. So this makes finance difficult. Really, you're always looking into the future and deciding. You're making lots of estimates and deciding what to do. All right, the goal of corporate financial manager. This is straight from the textbook, and this is the same thing they've been teaching for 30 years. Basically, every textbook you ever see says the goal of financial management is to maximize the current value per share of existing stock, or market value of equity, right? Because big companies can trade their stock. So current value per share of existing stock. But also market value of equity, whatever, even if it's a small business, it's still whatever that equity is worth. It's just on a small business, sometimes it may be hard to get a market value because you really don't know what something's worth until you sell it. Now, theoretically, this is a good goal since the owners own the company. Now think about this, right? If you're inside the company and you're a financial manager and you're trying to figure out what assets to buy and how to, finance everything, you are working for the owners, for the stockholders, for the owners. So you always act in their best interest. And if the market value of the equity goes up, that's a good thing. So theoretically, this is just the perfect goal. However, there's lots of problems. Let's look at a few of them. There's something called the agency problem, and the textbook actually talks about this. By the way, I mentioned these hot topics here in finance that people are debating historically. This book really doesn't talk much about what's happening right now. This book is still kind of the old school finance before our financial crisis. And in a few years we might have a slightly different definition in our textbook. This textbook, however, does talk about the agency problem. And an agency just means you got a stockholder and a manager, right? Stockholders are called principal, managers are called an agent, right? An agent works for someone else. They work for the principal. So agent works for principal, which means the managers are working for the stockholder. Agent, meaning the managers, are supposed to act in the best interest of the principal or the stockholders. But here's the problem. The agent is inside the business and has custody of the asset. Managers are here. Here's a picture, right? And the owners are out here with their stock. How in the world, if they're always out here and the manager's just doing everything every day, not only are they making decisions, they are in control of the assets and the accounting and everything. Right? So there's a problem here. How do you get these guys here to act in the best interest? So the agency problem, and this book talks about it, and really the ethical, how do you, managers do not always act ethically or legally. Now in the case of Enron and some of the great spectacular crashes, there was just massive illegal activity. But what about ethically? What about AIG? AIG did credit default swaps, which were perfectly legal, right? But it was clear in hindsight that this was not a good idea. It could only lead to the collapse of the banking system. So even though it was legal to do this, was it ethical? Very difficult problem when you have managers inside and owners outside. Now, some of the ways you can, I'm going to skip down here to this one. Right? So the question is, if the principal is not watching the agent 100% of the time, how does the principal get the agent to act in the best interest of the principal? Right? The way that most textbooks and most theory used to work is you say, pay the managers based on stock value. Well, what does that do? That makes the manager exactly like an owner, right? So if their pay is based on stock value, when it goes up, then the manager gets more. There's a couple problems, right? The one that's happened just throughout all of history is then the managers cook the books. That's a cliche to describe that they're making the accounting look good, so the stock value goes up, so they get their bonuses, right? But currently in finance, there's no definitive an answer to this, but this is coming into question a bit. But in theory, it certainly is a good idea, right? Because it makes the manager like the owner. Other even better ways, external auditors, right? So external auditors are, if we look at this picture here, I should have drawn a picture. They're the auditors, they're accountants that come in and go through all the books, right? Because somehow we got to get the financial information in here, out to the owners and the government and potential investors. So the auditor comes in and audits them. Now, hopefully they're independent. Unfortunately, again, recent history shows us some problems with this. The external auditors at Enron, Andersen International, came in to audit Enron, right? And they came in and they said, everything's really good. But it wasn't. Same with the financial crisis. The financial crisis, not only the external auditors, but the rating agencies and lots of other people, the regulators from the government, all fell down on the job. But in general, external auditors really tend to do, if you look at all of auditing history, a good job of going in and saying, hey, look, if the managers are inside or cooking the books, the auditors generally come in and say, you can't cook the books. And then that way we get good information out. Now, what does this mean? This says external auditors report to the board of directors. That means, if we remember our hierarchy here, so let's see if I can flip this. Board of directors, right? So they're up here. So really, the auditors come in and look at the managers, right? And then come out and make the reports and then go to the board of directors. That really is the way it should be. That way, if something's going on, they tell the board of directors. Let's see if I can flip this. Is that how I do? Okay, there we go. Another way is control over assets in accounting. That means there are controls before the managers ever get there that ensure that custody of assets and all of the accounting is done in accordance with rules and ethically and legally. Another way we get managers to act in the best interest of the principal, Sarbanes-Oxley Act. A lot of things happened. This was in response to the dot-com bubble, the big in 2000, 2001, the stock market went up and then crashed dramatically, mostly all the dot-com companies. And so a couple years later, Sarbanes-Oxley Act came out. And one of the things it did is it makes managers personally responsible for the financial statements. So they actually have to sign them and say, these are good. That way, later, if they turn out not to be good, then they can come back and say, aha, managers, you are personally liable for that. Another way is regulation, right? Like on insurance. If in the insurance industry, which is kind of a branch of finance that we don't talk about in this class really, but the regulators come in, and if you're taking out car insurance, the insurer has to hold money aside so that if you get in a car accident, they can pay you. That's a good type of regulation, right? So that kind of regulation can really help the managers act in the best interest of the principal. That always doesn't happen, as we will see throughout this class or talk about briefly on occasion. All right, problem number 2. Remember, we're talking about the goal of financial management is simply to maximize current value of stock. So maximize stock value. Okay, problem number 2. Financial accounting management gurus. All these are different. There's financial gurus, accounting gurus, management gurus. They always invent ways to circumvent or circumscribe the law that protect the owners. Lots of examples through history. I will just take the 2 most recent ones. Lehman Brothers did this. They issued debt, right? So they go out and they say, hey, I want to borrow some money. And then it's listed on the balance sheet as debt, which it should be. But then what did they do? They did these accounting tricks where they actually bought the debt back and recorded it as an asset, totally hiding the debt. Now, the thing is, this was legal. It was not illegal to do this. But was it ethical? Because if all of a sudden you're hiding debt, is that really good for the managers are inside are hiding debt? Is that really good for the stockholders outside of the business? So again, they did this to circumvent laws because you're supposed to show your debt on the balance sheet, right? And actually, there's a lot of other examples of way people hide debt, both within the law and outside of the law. Example 2, financial gurus invented credit default swaps to allow companies to issue insurance policies without holding equity in case the insurance had to be paid out. this is why AIG failed. This is in essence why the financial system itself came to its knees in 2007, 8, etc. All they did was they invented an insurance policy that circumvented the regulation. So AIG did not have to hold money in case they had to pay off their insurance policies. And then, of course, when the system collapsed and they had to pay off all these insurance policies, they had no money. But, what happened there? The government came in and helped AIG, which means us, the taxpayers. Okay, so circumventing the existing regulation sometimes really does. Even people who are free marketeers and say no government intervention. This is a clear example of when we all, even of us free marketers, we got hurt massively because there was no regulation. All right, and they circumvented the regulation using credit default swaps when they really should have just said, hey, credit default swap, that's insurance, let's put regulation on it. All right, and the interesting thing about AIG and Lehman Brothers is they're both dead, basically because they did these, they tried to circumvent the law, and it came back in the long run and caused Lehman Brothers to cease to exist, and AIG basically lost 97% of its value and is floundering now, mostly owned by the government. All right, problem number 3 with our definition. The definition of finance depends on financial markets being efficient, and all that means is accurately pricing assets. But we had 2 bubbles. We had the dot-com bubble and the housing bubble. Well, if there's bubbles where houses cost too much money, they're actually charging a price that is more than what it's worth. Or in the dot-com era, AOL or Webvan or many of the other dot-com companies, they were worth a lot of money. The market was saying they were worth a lot of money. The market was saying the house was worth a lot of money, but it turns out that they weren't, because it crashed and we could see clearly that the houses weren't worth what the market originally said. So that says that if markets are not always efficient, which means they don't always price correctly. Now, if managers are doing things to maximize current market value, but the current market value is not correct, the goal itself to maximize, current market value cannot be achieved because the mechanism to gauge whether the decision is good or bad is broken. All this means is if you're looking out into the market for a price, right, to tell you whether your decision is good or bad, if the house price is blowing up and you're looking out there and you said, I better buy this price so it goes up, not working efficiently. The market is not working efficiently because the actual mechanism, the price mechanism, is broken. Here's an example, right? 2000 to 2010, I should have put a 10 there. But here's the house price going up, going up. This is the market, right? So all of us are looking, saying, wow, look at that house price. I better get in and buy it so it can go up and up and up forever, right? So we went to looking through here. So we made our decision based on a market price signal. House going up a lot, I better buy it so then I can sell it later and make a profit. That signal was not accurate, because what did it do when it crashed? Everyone, we all lost our shirts, right? And the price is still going down. If you haven't noticed, this is 2010. You'd think 2008, 9, but it's still going down. All right, so this is an example. Markets, and by the way, that's not spelled right. And why do I do these handwritten notes instead of using PowerPoint? Mostly because PowerPoint usually makes people fall asleep. So I do my sloppy handwriting, which will probably put you more asleep. But since there's no red line to tell me when I misspell a word, like there is in PowerPoint, some of the words might be spelled wrong. I'm sorry about that. All right, market said the houses were worth a lot. This is a price signal to buy houses as an investment, right? Banks making the loans, individual buying the houses, and contractors making the house, and lots of other people, like Home Depot, Lowe's. They were all opening new stores, right? Because everyone was doing houses. All of these people react to that increasing price. But when the market was incorrectly telling people to buy, right? And so the market was actually giving us an incorrect signal. So all this the point of all this is that our original definition up here, way up here, if only I had PowerPoints and I could just jump to the slide, right? So increased current value of the stock. If that market itself is not accurate, then that puts this somewhat in question whether we can use it as our number one goal for financial management. All right. One last example. This is kind of banks only. This, you can look over this one if you want. Alan Greenspan, congressional testimony, said those of us who have looked at the self-interest of lending institutions, he's talking about banks, to protect shareholder equity, myself especially, Alan Greenspan saying, are in a state of shocked disbelief. All this means is that they assumed that free markets and individuals in the free market would never destroy all of the shareholder equity. And in essence, the banking industry almost collapsed across the board, specifically about banks. He just couldn't believe that banks would implode completely when managers were allowed to just do whatever they want. All right. Next topic. We're going to study corporate finance, but there are other areas of finance also. Investing. You can be a stockbroker picking stocks, or a bond trader picking bonds, right? Equity, debt. Portfolio manager, managing other people's money in a portfolio of stocks, like mutual funds or index funds or all sorts of funds. Or a security analyst. This is perhaps the most interesting. This is where you do all the research to pick the stock. Financial institutions is another area where you talk, banks, insurance, investment banks, institutions like that. And finally, international finance, other areas of finance that we're not going to talk about in this textbook. All right, why should we study finance at all? Hey, personal, what about student loans? What about credit cards? Again, this is a corporate finance class, but we are going to see awesome examples of credit cards, student loans, all sorts of things that we everyday people have to deal with all the time. How to make good decisions about whether to pay the minimum payment on a credit card. We'll actually see calculations that we can do in our own life from this corporate finance class that can help us. What about you making investments? What about retirement savings? We'll talk about that. What about banking? Careers. Basically, most endeavors involve some aspect of finance. Marketing, you have to do budgets. Not only that, in marketing, you have to analyze market plan, which means if you have a new product, you have to do hardcore finance. We'll learn later in this class about cash flow analysis using net present value, mathematical technique to decide what project to select. But if you're doing marketing and you're doing a new product, you better know how to analyze market plan using net present value. Accounting, basically, you can't do finance without knowing accounting. They're completely intertwined. Management. Remember, that's this class, right? Financial management. What do you invest in? What projects are best? Job performance, meaning aligning managers' incentives and interests with stockholders by paying them based on stock value. And personal finance. Again, this is corporate finance, but we'll see lots of personal finance examples in this class. What questions to ask? This is our 7th topic. Capital budgeting. All that means is what long-term investments, what assets do we buy? Equipment, buildings, investments. Capital structure. Is it debt? Is it equity, or is it our profits, right? Because guess what? When the company makes profit, you keep it as equity because that's the owners, right? So really, when you're doing capital structure, we're using new equity, new stock, debt, or our internal profits. And then working capital. This is the everyday nuts and bolts of running the business, right? This is short term. Current assets, current liabilities. We'll define those terms next chapter, chapter 2. It just means the short-term, in large part, your short-term cash coming in, cash going out. How do we collect from customers? How do we pay our bills? Topics like that are concerned with working capital. All right, we talked about financial markets, primary, secondary. Now, cash flow. Let's talk about the cash flows, because in finance, cash flows are everything. Well, wait a second. If we have accounting information that's not always cash, it's accrual accounting, how are we going to do finance? Well, chapter 2, we'll talk a little bit about that. But here's the flow of cash for a corporation, right? It says A, firm issues securities. So maybe in your initial public offering, right, you issue a bunch of stocks. People out in the financial markets, maybe we decide to buy some stock from this company, right? So the cash goes this way into the business. We get the stock, right? Cash goes in. That's one flow of cash. Now, firm invests in assets, right? We talked about we buy assets. We buy, machines, buildings, all that kind of stuff. What are we buying assets for? To get a return, right? So there's going to be, some cash from the assets. Not always, especially in the early years of the company. Maybe you don't have a lot of cash from assets, or the early months or something like that. But get this, it's going this way. But wait a second, it diverts here. It goes 3 different places. Well, obviously, you want to put some, especially in the early years of the business, you want to reinvest cash flows into your business to buy more assets, right? If you have a good idea, you want to keep it going. Some of it's going to go where? Back to the financial markets, not only paying dividends, but debt payments. And also some will go to the government and other stakeholders in the form of taxes, or maybe you even make some donations to and other stakeholders also. Cash flows of the firm. It's all about the cash flow in finance, not accounting numbers. All right, that's it for chapter 1. I will, though, however, take a break. And now I'm going to tell you about AIG, just like an analogy to understand how crazy it was, what was happening in the 90s and 80s when credit default swaps were invented. Here's us. We have a car and we want to buy insurance. So we buy insurance in case we have an accident. So let's just say we give AIG $100. Insurance company promises to pay if you get in an accident. So we get this little policy, number 1. Number 2, AIG spends your $100 and does not save any money at all in case you get in an accident. Now, they didn't actually spend it, but they did get rid of it. They didn't keep it any money for your policy. Number 3, AIG sells 1,000 more insurance policies to other people, betting that you will get in a car accident. Now, this is the hard part that people usually don't understand about credit default swaps. We can understand this, right? You buy an insurance policy, and if you get in an accident or something, they pay you. But what credit default swaps allow you to do is AIG, there's 1,000 other people looking at you, and they're betting that you are going to get in an accident. So they don't even have the car, they're not you, but they can still buy an insurance policy called a credit default swap. So let's just say AIG sells 1,000 other ones. So that means 1,001 people have. AIG should put a lot of money aside to pay this off. All right, so here it is. Here's the total, 100,000. And AIG, so it's $100 each that AIG gets. AIG spends this and does not put any money aside in case you get in an accident. Now, they don't really spend it, but they actually don't have it. They put it into other things, but they didn't put any money aside. So government regulators do not force AIG to put any money aside. Now, in the real car insurance industry, they do. The regulators come in and say, no, AIG, you got to put some of the money aside. And the regulator says, hey, AIG, I know that not everybody is going to get in an accident. So maybe they they make them put aside a proportion of the amount so the people that do get in accidents can be paid. But in this example, this is a parallel example of credit default swaps. Regulator says, don't have to put anything aside. And then you get into a car accident. You ask AIG to pay the $100. The 1,000 other investors ask for their $100. AIG has no money. They cannot pay. That's a credit default swap, and that's what led to our financial crisis. What happened with AIG for the actual credit default swap wasn't car insurance. It was just a loan. Here's a loan to ABC. Here's the lender. The lender goes out and says, I'm going to buy insurance in case borrower ABC can't pay me back. So buys insurance in case borrower does not pay back. Now that's perfectly all right. And a lot of the corporate credit default swaps in the 90s worked kind of like that, right? It was just an insurance policy the lender took out. But now 1,000 other people buy insurance on the ABC, just as like in our earlier example, even though they did not lend the money to ABC. And this was what happened with all of our mortgage debt. People went out and bet against people not being able to pay off their mortgages. And again, it would not have been bad if AIG just put money aside. But AIG spent all the money, or put it somewhere, they got from the insurance policies. AIG did not put any money aside, which is actually what happened, in case ABC borrower does not pay. ABC does not pay. AIG has no money to pay. Everyone is hurt. That's what happened in the financial crisis. Notice down here I say, except for government gives dollars to AIG to pay off their contracts, and that's what they did. Us taxpayers came in and gave a lot of money to AIG to pay off. But AIG didn't have the money to pay off the insurance, but the government, us, the taxpayers, gave money to AIG. All right. We don't get to talk about credit default swaps and any of these big, heavy issues, but I thought in Chapter 1 I'd just give you an example, too, of the current financial crisis. All right, next chapter, Chapter 2, is going to be all about financial statements and looking at accounting numbers and then trying to figure out cash numbers from accounting numbers. All right, see you next video.